Welcome to this week's UK mortgage market briefing. If you're expecting big headlines or dramatic rate moves, sadly this week is more about stability than surprises. There's been a mix of rate increases and rate decreases, swap rates are broadly unchanged, and the wider market is taking a breath at the start of the year. What is worth paying attention to though is what the latest house price data tells us about affordability, buyer behaviour, and why some people should act sooner rather than later. This week, a handful of lenders have made some very small pricing changes, the likes of HSBC, Halifax, Birmingham Midshires, among a few others. Some up, some down, across residential and buy-to-let. But if you want to know specific lender rate changes as they happen, I do share those in real time on my Instagram stories, the minute they land in my inbox, so go follow me over there if you want to get details on those. Swap rates have fluctuated slightly during the course of the week, but compared to where we were a month ago, they're virtually identical. And that's important because it explains why lenders aren't rushing to reprice aggressively in either direction. At this stage of the year, lender behaviour is fairly quiet, no major strategy shifts, and no big pushes for volume just yet. And this is all fairly normal for early January, especially with limited economic data coming through. Well, this week there's been no major macroeconomic data, but we have had the final house price figures for 2025 from the Nationwide and the Halifax. Nationwide reports that annual house price growth slowed to 0.6%, down from 1.8% in November. And their summary for 2025 is that overall prices were resilient, but activity did slow towards the end of the year. And I think this is largely due to the uncertainty around the late autumn budget. Regionally, all areas saw growth, except East Anglia, where prices fell by 0.8%. The strongest performing region was Northern Ireland, seeing annual growth of 9.7%. Now, Halifax is telling a similar story. They recorded a drop in prices of 0.6% in December, with annual growth of 0.3%. And they also described the market as subdued at the end of the year, but their outlook is cautiously optimistic. Their key points are that interest rates are easing, product choice is improving, particularly for people that are borrowing at higher loan to values, and while affordability is still tight, the house price to income ratio is now at its lowest level in over a decade. Halifax is expecting to see house price increases during 2026, somewhere between 1 and 3%. Now, for homeowners and remortgagers, this is a period of relative calm. Rates aren't racing down, but they're also not moving against you in any meaningful way. For buyers, particularly first-time buyers and home movers, the combination of slightly softer prices and gradually improving mortgage availability creates some opportunities, but timing matters. Now, a recent report from Moneyfacts shows that more than half of borrowers currently favour 2-year fixed rates. I think it's no surprise when you look at the news that the assumption many people have is that rates will fall further. So in their eyes, a shorter fixed rate feels safer. However, it's important to point out that while that might happen, it's not guaranteed. There are sensible reasons to choose a 2-year fixed rate, such as flexibility if you plan to move or expect a change in circumstances. But choosing rates based purely on headlines can be a big mistake. One point that often gets overlooked is affordability. If borrowing capacity is tight, many lenders will actually offer more flexibility when you take a 5-year fixed rate rather than a 2-year fixed rate product. And let's not forget, we are also starting to see lenders come to market that are offering much longer term fixed rates, say 10, 15, or even 20 years. And their affordability models look even better in some cases. This is why product choice should always be linked to your personal plans and not market sentiment. Now, if you're a first-time buyer or you're looking to move home, now is a period worth paying attention to. As property prices have softened slightly, this is starting to create opportunities to secure some good value. But as rates gradually ease, buyer confidence tends to return. And when demand picks up, prices usually follow. At the moment, this still feels like a buyer's market, but that can change very quickly. So the key message this week is very simple. This is a market that rewards planning, not prediction. Rates may drift lower and prices may edge higher, but the right decision depends on your timescales, affordability, and future plans, not what the latest headlines are saying. If you want to stay on top of lender rate changes as they happen, please follow me on Instagram because I share daily when lenders change their rates in my Instagram stories. And if you're planning a move, a purchase, or a remortgage this year, start the conversation early because it gives you options. That's it for this week. I'll be back next week with another UK mortgage market briefing. Take care.